Welcome to the Airmere Roundtable. Today is the 12th of February, 2020, my oldest son's birthday. So happy birthday, Tim. And nice to have Ryan and your team here from Black Pier Capital. We've been on before a couple of times, so it's always a pleasure to have you back. And always a good relationship, so happy to have you. So
Yeah, we love being here. We appreciate it. I guess you want me to just dig in?
yeah, just little disclosure action, and then I'll put myself on mute just in case there's any background noise that would distract. I don't want that to happen. But if there's any questions, or I'll chime in. I'll be here the whole time.
Okay, perfect, great. Appreciate it, and we love questions. So and at the end, we love question answers. That's where we feel a lot of the good stuff happens. So, we'll dig into here. Again, our title is our hard-earned lessons from the past decade. With turning into 2020, a new year, a new decade, we really look back and see some of our challenges, some of the things we've worked through, and kind of walking through that, kind of through the presentation today. Hopefully, we'll have some good principles and some good lessons from our challenges that will help some of the other traders. So really a disclaimer real quickly. This presentation, we always have disclaimers. This presentation is for educational purposes only. Again, with trading, there's a high degree of risk. Black Pier Capital is not affiliated. Assume no responsibility for your trading. Anything that we show here today, indicator strategies, columns, articles, there are for educational purposes only. We are an investment advisor, but we are not a broker dealer. We do not recommend any of the trades that we're showing, and they're all hypothetical, and again, for educational purposes only. Obviously, I think with the recording, they can pause that and read the rest of it for the disclaimer purposes.
Absolutely.
But a little bit about Black Pier Capital. If you're not familiar with who we are, again, we've been on this, we've been on Airmere a couple of times. I love what Tom does here. I love the community. It's fantastic education when it comes to the option space. What we do is we actually specialize in the managed options exposure space. So what is that? Managed options is basically systematic option strategies that create a certain exposure for our clients. And our clients are going to be individuals and family offices, so institutions as well. And what we want to do is we want to give them the systematic edge of time decay. And again, most people in this community will understand what that is, but we want to do that by mitigating directional and volatility risk as much as we can. And so with our clients, a lot of them, they're going to have, different portfolios, traditional portfolios. They're going to have stocks, bonds, real estate. So what we want to do is give them another asset class within their portfolio. Again, we see kind of like the Ray Dalio or the Bridgewater all-weather model is really one of the kind of easiest ways to mitigate risk. And for us to be a small part of that is kind of fundamentally give them a different return stream, which is obviously the edge of time. And so we do that, again, with separately managed accounts. We do that in private partnerships as well. So again, everything that we're going to say here today is kind of from where we are coming from or how we trade. And I'm going to mention that a few times. But first, let me talk a little bit about the team, which the team being me, Chief Portfolio Manager. I created Black Pier actually a decade ago in 2010. And before that, I was trading options for another 5, 6, 7 years before that. So I've been doing this quite a bit and kind of doing this more in a professional sense for the last decade. Got Tyler and Wayne. So Tyler and Wayne, they're going to be strategy development, execution, really being a small firm, you're going to really do whatever we need to do. But both of them are extremely good at what they do. One thing we always mention with teams is any new traders, get with a team, get with people that are like-minded and trade ideas, because really when you get with a team, 2 + 2 does equal 5. So when you start building on other people's ideas, it really is something special. And it's hard to trade alone. So working with other people, it just creates a lot more output than you could as an individual. So with all that being said, why are we having this presentation? And, why did we want to come on here and present? And really 2019 for us was, I would say, kind of a watershed year. Trading over the past decade and beyond, we've had a lot of challenges. And, one thing I have up here on the slide is that our expectations versus results. We started seeing a vast amount of variability within our results versus our expectations. And so where did our expectations come from? So a lot of people that know us and understand how we test and retest, we get a lot of data, and we're very systematic in our trading. So again, we want to make sure that the data is telling us something, not our feelings or not what we think. We will actually want to be proven statistically exactly our idea and how it works within the market. So, in real life, we've traded thousands and thousands of different trades, and we've tested probably a million different iterations. But that gives us a data set, and that data set within our strategies will give us kind of an expectation funnel. And that expectation funnel will say, okay, well, how much do we expect to make in a certain environment or lose in a certain environment? And what we were starting to see, especially the last few years, is we really pay attention to, is our results kind of within that funnel? How's the variability in those? And we started to really see, like, we've got pretty wide variability in this. And so, when I talked to Tom, I had a couple questions for him in January, but I'm like, can we present? Because 2019, we started to ask a lot of really hard questions about this because our results weren't matching what we thought they should. And when I talk about variability, what it boils down to is our losses seem to be bigger than we thought they should be, and our gains weren't as big as we thought they should be. So those two things can start, they can start forcing you to ask some questions and tackling assumptions and, tearing down your belief system. And so that's really what we started to do. And just kind of fast forward through the presentation, what came out of that is we stripped down really everything we were doing and rebuilt it in order to really kind of get on the right side of fundamental principles of the market. And so one thing we wanted to do is we lean very heavily on our data, but is our data set going against fundamental principles of the market and just good trading principles? And we'll dig into that a little bit, but really what we created kind of out of the ashes, kind of a phoenix rising out of the ashes, is actually one of the most consistent strategies we've kind of seen. So really with that consistency, that's what we'll dig into today is why were we having the variability? And, are we going to be on the right side of these kind of core market principles, fundamental trading principles? And really while I'm on the subject, and I've got principles versus specifics, one thing I want to kind of note here is kind of when we give presentations, we want to give principles over, because really anytime as traders, we've taken, let's say, specifics from some presentation or somebody's trades, it's usually never sustainable. Not saying that the trade isn't sustainable, but the specifics from any sort of somebody else's trades that's specific to them and their trading style, versus taking the overall universal principle that really can kind of mold or meld with any sort of trading strategy. So I do want to highlight that just to say we're going to really try to boil things down to the principles that we've learned in order for people to use that within their trading, because that's the whole point of us doing that. So we're going to be going over, Greeks and looking at different structures and stuff, but that's all kind of for an example in order to kind of get across kind of universal principles that we've learned. And again, this is for our trading and how we trade. So again, this is what works for us. We've got a big corollary there. So again, take some of this stuff if it works for you and ask questions. It's all about asking the right questions within your trading. So again, with all that being said, let's dig in first to what we were doing. So when we were having all this variability when our trading, and again, a lot of us that kind of know what we do or how we trade or the exposure we have kind of for our clients and for ourselves, generally we're going to be butterfly traders. And I would assume, Tom, you can tell me if I'm wrong, but I would say most people within the air community are pretty familiar with a butterfly or a broken wing fly.
Oh, absolutely. It's a core structure that people use.
Right. It's very core. And there's a reason for that. It's very efficient. It's a great risk reward. We love it. This has kind of been our core structure for a long time, probably 10 plus years. And again, we love the structure. It's a broken wing fly you see here. And that's really kind of what we based a lot of our strategies on. And so what we would have is our trading would pretty much be based on a delta neutrality. I'm not saying you can't lean it one way or the other, but for most part, as Greeks come, it was a small part of the position. So, before we would have a bearish position that would pretty much stay bearish, broken wing fly, and then we'd have something that stayed pretty much bullish, and then we'd have another strategy that was more tactical. So it would lean bullish and bearish depending on what the market sentiment was or what the system would say. So again, three main strategies, and we would control the delta by, a lot of people in the community understand how to do that, right? Through verticals or adjustments or calls, whatever it may be. So again, just the idea of we are controlling the delta. We are staying quote unquote delta neutral, if you can understand that. And then we'd really kind of try to mitigate the volatility risk or the Vega risk by layering. And so really what we do is, let's say we have 3 strategies, and we would, our assumption was we would want to get to that theta component, right? We're trying to give that edge of time. And so our assumption is we need to have that on consistently. So we'd place these trades at the same time each month, same DTE. So let's say 70, 75 DT, days to expiration, we'd put one on. And layering, we'd say, okay, put one at 75, and then we put another one on at, let's say, 70, then another one at like 65. And we do that to try to mitigate, our Vega risk or kind of Vega shock risk. Whereas let's say if you get one position on at 75 DTE and you have a Vega spike, well, at least, the old position may get hurt, but a new position will take advantage of that new volatility level. So again, we layer to try to mitigate the kind of the risk in the Vega. We'd obviously adjust to mitigate the risk in the delta in order to try to get to that, again, to that theta component. We're always in the market, layering the positions and manage the directional risk. Well, the question is in 2019, we started asking questions, why are we having this variability, right? So we've got all this going on, and let's even talk about the execution of it, right? So you've got 3 strategies, you've got layers for these 3 strategies. So let's say 8 or 9 actual different structures that you're managing. So, and we trade a lot of contracts. So if you're looking at that, you're looking at a lot of execution, things moving kind of all over the place. So execution time would vary widely. I mean, to a few hours to like almost most of the day because of the stuff we had to move around. And with all that work being done, we were still having high, basically high variability in what our expectations. Like our losses continue to be, when we would lose bigger than we thought we should. And then again, when we were making money, it didn't seem to be as much as we think it should be. It's over the course of the last couple of years. And 2018 was kind of a wonky year. I think a lot of people saw that. You had very low volatility into kind of a crash, very high volatility, and back into low volatility, back into high volatility. But 2019 was a almost very normal year. You had high volatility that came out because the market went up. You did have a couple moves down, but for the most part, it was very normal. And so for us, start asking those questions, like what's going on? And so now we want to sit there and be like, okay, well, are we on the right side of just general how market fundamentals? Do we understand how the market is actually working? And do we have good trading fundamentals? And so when I say that, like when you read through, like just say a Market Wizards book, if you talk to any one of the best traders, what sort of trading fundamentals are they staying on the right side of? If you read through Market Wizards and you take every single story that all those traders talk about and you pull out the trading fundamentals, are our positions on the right side of that? So these are just questions we're asking ourselves. What's going on? And when I talk about market fundamentals, some of the ones we list here. So pretty much any good trader, you want to identify your good and bad environments for your trade, right? So is there a better time or a worse time to have our trade on? And so with us, it's kind of very interesting, and we'll kind of dig into this, where what some of the good and bad environments are. And anyone that knows kind of a broken wing fly, you could probably think of some good environments and some bad environments. So really breaking that down. Understanding what's driving the P&L of the trade. So this is kind of a question I have for a lot of traders. Do you know exactly what is driving the P&L of the trade broken down between your Greeks? So, how much is Vega attributing to the gain? How much is Delta? How much is Theta? How much is Gamma? How much is all those actually attributing to the gain or the loss? Another one, understanding the fundamentals of actually the product that you're trading. I know, Tom, you mentioned now you're trading currencies. So we are pretty much, we focus on the indexes. So really that is our product, is going to be the S&P and the RUT. Now pretty much the S&P. So do we actually understand what's going on with the actual product and how it works? And again, consistent inputs equals consistent outputs. That's not so much a trading lesson or a market lesson like fundamental, but that's kind of a life fundamental. Anytime you try to program a computer with inconsistent inputs, there's no way you're going to have consistent outputs. And so really all 4 of these, the reason is like, why do we want to be on the right side of this? Because these have withstood the test of time. And so the one thing that we want to look at is like, okay, we've got a data set, and pretty much any data set is going to be finite. So we want to sit there and, Ray Dalio always mentions foundational principles. Well, the reason they're foundational is because they've lasted for a long time. When I talk about long time, I'm not talking about 5 or 10 years, like talking about 50, 100 years. And because of that, they'll probably persist in the future for another 50 to 100 years. So we want to be on the right side of those. So these are the questions we kind of start asking about our position. So when we did that, all right, well, let's kind of tear it apart from the data set and let's look at actually what the position looks like. And so, tell me if I'm wrong, Tom, but I'm going to go over kind of the just the basic setups of just a fundamental just broken wing fly, look at the Greeks and kind of see how it jives with how the markets work. So this is just your basic, we just had an example of a broken wing fly. This is going to be a $50,000 trade. And in this, I think this example is from 2008. So this is a higher volatility example. So I think the VIX was around 50 at this point. This is the S&P 500. And so kind of looking at the structure itself, one thing I will mention about these structures is the structures we're going to look at, they have been dynamically sized. And what I mean by that is the size of the structure has been, is going to be dynamic to the volatility in the market and also the size of the asset. So however big the index was at the time and also the volatility, it's dynamically sized to that. If you have a lot of questions about that, because we're basically just having that as example purposes, we did an entire presentation on that. It's on our website, because that's very, very important to understand, is for us being dynamically sized, because we want to make sure to keep everything consistent for our expectations with skew, how the options react to each other. So that is a big point. And for our example purposes, we're going to have dynamically skewed structures. So again, this is 2008. I'm going to show you one in low volatility. Just know that they're going to be dynamically sized. So that's going to be a constant within the example. So just looking at this example here, you've got a broken wing fly. If you look at the Greeks, once again, the way we trade, we look to mitigate delta as much as possible. So delta is going to be a very small portion of the Greeks. This one has basically a -3 delta, very small. Gamma is very small as well. If you look at the Vega theta, so if we're looking at the relationship of volatility risk, Vega, versus what you're getting paid in time, theta, you're looking at about a 2.5 relationship. So your volatility risk to your theta risk. So pretty much with any sort of, a broken wing fly, what's going to be your biggest Greek kind of by far? And I think most people would see it. It's going to be Vega, right? And so it's negative Vega. So generally in negative Vega, when is negative Vega going to hurt you? Tom, I mean, you would probably know, right? When's negative Vega going to hurt in a position?
Oh yeah, big moves down.
Big moves down, right?
Quick ones.
Right. So if we're talking about kind of how, the market works, I'm glad you mentioned that, how it moves down. Well, what we call that is a volatility expansion, right? So when the volatility expands, and what's interesting is you just mentioned the market moving down, but it's actually the volatility expanding. But what you just hit on was a market principle, right? That you're going to have a price volatility relationship with the indexes of generally when the market moves down, volatility expands. And when the market moves up, generally volatility is stabilized or contracts. And so I say that, and going back to our market principle of understanding how the market structure works, well, when the market moves down and volatility expands, I'll have the biggest number of my position as a headwind. It's going to be moving against me. So just looking in this one position here, not talking about adjustments or rolling back or anything like that, would I want to be in this position here with a market moving down? And this is questions we're asking ourselves just as a position, and you start seeing, well, I don't know, maybe I wouldn't want to do that. Now for us, we would want to have theta on all the time, because we thought, hey, we need to have consistency and we need to have a constant theta edge on all the time in order to capture that. And our data set would tell us that, we would need to go through these environments where the market moves down, or you have, sharp spikes in volatility to get to the other side of it. And so, with that being said, we'll go to our next example. Okay, same structure, right? So this is going to be again, broken wing fly. This is going to be a low volatility setup. So this is going to be in 2018. I believe it was 2018. Tyler, tell me if I'm wrong. Well, it says it right here, 2018. This is going to be at about 11 VIX. So again, much lower than what you have in 2008. Obviously, you can see some distinct differences. Again, this is dynamically sized with the structure. So again, the skews and everything are going to be consistent within each other. But let's look underneath the hood. The delta is going to be very minimal. Again, this is going to be positive versus negative, but in the scope of the position, it's going to be very, very minimal. Gamma is very minimal. Let's look at the volatility versus your time. So your Vega risk versus your theta. So now both these trades are on at 59 days to expiration. So let's look at the relationship of the Greeks between Vega and Theta. So now, instead of you have a 2.5 to 1, now at 59 days, you've got a 14 to 1. And let's talk about another market principle that's gone on for a while, and I think most people agree, is volatility is mean reverting. So again, when I'm thinking about market principles, something that's lasted for a long time that I think it's going to persist. And those two things within the indexes of price volatility relationship, when markets go down, volatility generally increases, and volatility is mean reverting helps us out quite a bit looking at these positions, because I've got a massive Vega position compared to my other Greeks at one of the worst times possible, which is going to be at 11 VIX, because generally, not saying the VIX will go up or volatility will expand, but the odds are it's going to expand a lot quicker than it's going to contract. So again, just looking at flat out the position here, not talking about it being part of a system or any adjustments, would I want to be in this trade when the market's going down? And I think most people say, well, if I didn't want to be in the other trade, obviously I wouldn't want to be in this trade. And so this is kind of things we're looking like. So do these trades act with how the market actually works? So I'm in something that the biggest Greek is negative Vega. And if the market starts heading down, then it's going to be in my face. It's going to be working against me. So one thing we started looking at is like one of the market principles is understanding where our P&L is coming from. And I'm skipping around a little bit. So definitely, any questions, please ask them or ask them at the end. But the two questions we're trying to answer here is like, where are gains coming from? If they're too small or too large, where are losses coming from? And so when we look at this and we've been having some huge variability in our results. Well, if you look at these two trades, these both are broken wing flies and they both are dynamically sized. So if we've got a system that puts them on at 59 days to expiration and a certain size, then we're going to be in both these trades. But they're totally different trades with totally different risks. So if you look underneath the hood, one has a 14 to 15 to 1 relationship between volatility and time. One has a 2.5 to 1. Obviously, we know why, right? Because of the volatility difference. But if I'm trying to get consistency within my P&L, how in the world am I going to have inconsistency when it comes to my risks? They're totally different trades underneath the hood. All right, so we start asking these questions like, okay, well, what if we had the same relationship within our Greeks, right? What would that look like? And anyone that understands, broken wing flies. So Tom, if I've got something in, a low volatility and it gives me a 14 to 1, let's say Vega Theta relationship, and I wanted it to match a 2.5 to 1 Vega Theta relationship, what am I going to have to do with that position?
I need to cut the risk down.
You cut the risk, or pretty much in order to match the Greeks, you can't be at 59 days anymore, right? You've got to push it in time in order to get those rates. Because again, in order to match, you're going to have to make some changes. And so that's what we looked at. How do we get consistent Greeks? Not saying this is what we want to do, but if we want consistent inputs of our risk and consistent with our expectation and relationships, what would that look like? And this is what it would look like. So again, in order for us to match the Greeks for these two positions, or I'm sorry, to make the 2018 position Greeks look like the 2008 position Greeks, we'd have to go all the way into 8 days to expiration. So now if you look on the very right side, you'll see the Greeks almost are identical when it comes to Vega Theta. Obviously Delta is pretty mitigated. And so now the relationship is the same. So what's different now? So now that your volatility numbers come way down versus your theta, what has increased quite a bit? Your gamma, right? So again, for us, we're like, well, that's too much gamma. So this is the questions we had. We can't do that because, that's too much gamma. You're at 8 days to expiration. And again, these are questions we're looking at. How can we be more consistent with our P&L? What is causing this variability? So what you would notice too is the one on the right side, utilizes $11,000 versus the 2008, and the one in the middle are $50,000 trades. So in order to get the same exact Greeks you'd have in 2008, you'd actually only have to utilize $11,000. So what's interesting is the gamma number that you have, the higher gamma, is actually this very, very similar, if not the same dollar gamma that you would have in the 2008 position, dollar for dollar. So when we started seeing this, we're like, okay, well, now you can position size. And so now you're getting more consistency with your relationship, more consistency with your Greeks. And, you know, for us, it was a lot of a gamma. That's too much gamma. But when you can position size within your portfolio or your account or whatever it may be, and you're getting the same dollar for dollar movements, except now you're getting more consistency with it, it started to be, okay, well, what if we do this? All right. So that really starts to answer questions. Well, we understand where the variability is coming within our P&L, but what's causing, you know, the drawdowns? What is causing, that's another question. Where are losses coming from? And so again, for the last decade, when we look back at our biggest drawdowns we've had on our trades and our systems and our strategies, when have they come? And almost every single time, you know, like, you know, you mentioned it, Tom, it's in volatility spikes. And, you know, I think a lot of traders, you know, I think a lot of traders kind of look and say, you know, for us, we had kind of the assumption we needed to be in consistently because we've got to get on the other side of that. Well, when you look at this, and we're just showing this volatility from 86 through 2017, is what's interesting is we start asking the question, well, do we have to be in during those? And so when we started cutting up our trades and cutting up our results, and we separated them, and we, you know, talking about good environments versus bad environments, right? You need to understand when it's good to have a trade on and when it's not as good to have a trade on. And when we separated it from a volatility expansion environment to a volatility contracting environment. And what's so nice, and one of our largest edges is in an index, we can pretty much tell when that's going to be, right? Tom mentioned it. When is the volatility going to expand? It's going to expand when the market moves down. When is it generally going to be more stable or contracting? Generally when it goes sideways or up. And so with us, we're like, well, is there a way to just have something that keeps us out of those times when the market screams to the downside or crashes, or just keeps us out of those expansionary environments? And what's interesting is you can get 1,000 different ways to tell you that: moving averages, price action. So we just wanted something very basic, because something very basic is generally something very robust, just to keep us out of those. And so when we started doing that, putting those together and like, okay, well, what if we stayed out of bad environments? Because again, from our data set, that told us when we were having our largest losses. And then what if we had consistent Greeks throughout everything? So we're not going to start the same position at the same time each month, because that's not what the market is saying. That's what we're saying. The market is saying, if you want consistency, you're going to have to move your position around, and you're going to have to position size it, and you're going to have consistency in Greek. So when we did that, you know, and taking those two main ideas and then kind of put it through our data ringer, meaning we test it, and really kind of an out of sample test. And one thing is we really didn't have a goal to get to any certain consistency. We really didn't have a goal to get any certain return. Really what our goal was to have good trades on. And our goal was to stay on the right side of these kind of core trading principles of, you know what, there really isn't a trader out there, and a very successful trader, that has the same trade on all the time. And, you know, read through Market Wizard books, they're going to pick and choose. They're going to get the right setups. And so we want to make sure that we've got the trades on when it should be on. And so, okay, we're going against a lot of our assumption beliefs, but this is something that we wanted to kind of look into. So we wanted to be on these core principles. And so we wanted to build it from there. So once we did that, take those general ideas, put it through the ringer, and what came out was pretty awesome. And we show this is our strategy. We call it the Black Pier Lotus. One of the reasons we call it the Lotus is because Lotus grows out of really murkiness, which is, I think, a lot of what we had. And we really kind of cut through all that. But what it is we ended up with much more consistency. And when we talk about kind of how we trade, again, you know, we want people to take some ideas and good questions and put it to their own trading. But really what we look for with inconsistency is we look at a systematic way, and then what we call a princimatic way, which is like you're going to combine systematic with principles. So we want our trades to be kind of grounded in those universal trading principles of our trades being on in the right environments, and understanding our trades kind of working with how the market works. And so understanding that, I mean, I don't know how many times you'd be in a trade for, you know, 20, 30, 40 days and not make a dime. And so if that's the case, you had risk on for literally a month, but not make anything. That's frustrating. And so that's what we wanted to break down with all our stuff and figure out what's going on. So once we got under the hood and started really getting the consistency, when we put each trade together, the data set, and if we kind of look at this, our old way of trading, when we talk about net returns to risk, and when we talk about that, we're talking about annualized return to max drawdown. We were about a 3-to-1. And when we kind of use those very consistent principles, but also stayed out of those environments, it skyrocketed to 7-to-1. What's really cool is I mentioned how our capital requirements. So generally with an account, we'd use most of the account, 90% plus of the account in order to get that return. Well, as I kind of mentioned with position sizing, with us being consistent with our Greeks and going where the relationship was the most effective, now we utilize half that, if not less. So we're buffering a lot of the account with cash and getting the same return with less drawdown. And what's very interesting is because we're staying out of certain environments when the volatility is expanding, on average, about half the year we're in cash, but still getting the same return as we did with just a pure systematic strategy. And then execution time, this is something that I think Tyler would say more than anything. Our execution would last, you'd have busy days and it'd last all day. I mean, we're moving 3 strategies with multiple layers around. And when we stripped all that away, I mean, you went from 2 to 7 hours of execution time, and that's almost on a daily basis, maybe 2 or 3 times a week. And that pulled it down to 15 to a busy day would be 30 minutes. Most of the time it's about 15 minutes, if trading at all, if we're even in the market. And so what's really interesting with that is what we call fractal consistency. And again, this is what we looked at. I mean, I know we have other traders that look for the biggest return. What we look for is the best risk reward, and with a good return, a good solid return that is good for us and for our clients. But when we talk about fractal consistency, I come from a baseball background. So when we're talking fractal, generally what I would always do during the season is I would always try to go every 10 at bats. And so if I know if my process is consistent, that I know 1 bat or 2 at bats or 3 at bats, you never can tell. You can get out, you can do everything right at the plate and still get out. But over the course of about 10 at bats, you can get a pretty decent average of how you're doing if your process is consistent. And we talk about fractal consistency. I wanted my 10 at bats to look like my average for my 50 at bats, which would look like my average for 150 at bats. And so what that means, it means there's extreme consistency and very low variability with how I'm approaching every at bat at the plate. And so what we found within our trades was, in kind of the old way we were doing it before we really kind of broke through with kind of these aha moments, was you would see some wide variability. If you took a swath of, let's say, 20 trades, it would really be environment based. Of like, you could take 20 trades from like 2013 and they wouldn't look at all like the overall data set, or 20 trades from 2008 and they wouldn't look at all like the data set. And because, again, when you think about it, we were in all environments. So sometimes it would do okay, sometimes it wouldn't. Now, when you talk about consistency, you can take really 20 trades of any year and it's going to look a lot like the overall test itself. So it's fractal. So, now obviously from one trade to the next, you can have winning trades, you can have losing trades. But if you get a good statistical kind of sample, then it should, if there's consistency there within the inputs, then the outputs should continue to stay consistent on a fractal basis. So, what came out of this and kind of utilizing those universal points to us was huge. It simplified everything. There's a lot of experience. There's a lot of pain that went behind these strategies, but that's kind of what we had to go through to see what worked, what didn't, but also just going from a principle-based standpoint of, is this position on, is this going through good market principles and good trading principles? And so kind of what we had is what questions we wish we would have asked 10 years ago, things that would have really helped us out. And so we want to present these. Hopefully it'll help out other traders. But, first one, are there parameters determined by you or the market? So when we were putting trades on, we were putting trades on the same time every month. Well, is that us doing that, or is that the market telling us to do that? And so when we started looking at the variability of results, well, us putting on at the same time every month, every time we put on a new trade, it was going to be totally different than the last time we put it on, because the market changes, the volatility changes, the asset size changes, all that's going to change. The environment is going to change. So we were setting ourselves up for variability, setting ourselves up to not have that consistency. And so we always want to ask, like, what is determining where we're going to trade or how we're going to trade? And it should be the market, because that's obviously the market's always going to be right. Are there any static points in the trade? This is huge for us, because we know that if we have anything static within our trade or in our setup, and if we put that into a fully dynamic market, which the market always is, it's not going to be sustainable. And when I talk about sustainable, I'm not talking that if it works or not. I'm talking about the expectation of it working. So, if you think about it, like, let's think about a 20-point wide fly in 2006 versus a 20-point wide fly now. It's totally different. The skew is going to be different on it. It's a different trade, because the market's bigger, volatility is bigger, your average range of the day is going to be bigger. Again, we want to make sure that there's nothing that's going to be left to a static point. And that really boils down to the relationship of our Greeks. That's really where we kind of took the staticness out of our trading. Every single day, looking at your position, is this a good trade? We just got an email from one of our friends, and he sent over, and it was a lawsuit that came on Catalyst. Tom, I don't know if you've heard this, but they were selling naked calls, and it's a $4 billion fund. And literally this guy wasn't really doing much risk mitigation at all. But if he literally would have asked himself this question on a daily basis, he would have gotten out of the positions way earlier. As it so happened, he ended up losing $500 million, and he's part of about 4 different lawsuits. So that sort of stuff, that question can keep you out of a lot of bad environments, because when you look at it, is this a good trade? And when I ask that question, is it a good trade for the environment I'm in, for the market I'm in? And does it agree with how the market works, how this trade works? And again, that's a great question to ask. Day 1 of a trade, day 5 of a trade, day 20 of a trade. Number 4, is this profit worth the risk? So when we looked at kind of split up our data set into expanding market volatility versus contracting market volatility, and how our positions did within that, it's kind of interesting, because it's not that we wouldn't make money doing, let's say, being in expanding volatility, but the risk reward totally flip-flopped. So in a very kind of stable or contracting environment, our risk reward be extremely high, and that flip-flopped when we go into an expanding market environment. And so, yes, maybe it's still profitable, but is it worth the risk being in it? And to us, it was blatantly obvious that it wasn't. Because once you do that, you take out a massive amount of risk, and a massive amount of risk for the data set, but also things that aren't in that data set. So when you're not in an expanding market or expanding volatility environment, what do you avoid? Well, you avoid a 1987 type crash. And look back in history, there has not been a quote unquote true crash off of an uptrend in the market. Now, obviously, it's determining how it's up to how you determine that uptrend, but crashes don't happen out of nowhere. They just don't. Look back since 1900, because that's what we do. And 2, when we're looking at universal market principles, we want to see what's worked over the last 150, 200 years. And so this is something, is it worth that risk? And then number 5, Tom, I don't know if you've ever done this. Are you ever hoping the market does something? You ever sitting in a trade and be like, please go down, please market go down?
Yeah, the hopium.
Yeah, the old hopium. And it's a strong drug. It really is. But it's one of those where it's, when you're looking yourself as a trader, and one thing I do quite a bit, I meditate quite a bit. And what that does, it gives me some really it really allows me to view my inner monologue, but also kind of what I'm feeling. And what I've realized over the course of the last decade is anytime that I was in that, it was massive red flags on the position. Because if I'm asking that question or hoping the market does something, it means I didn't ask the question, is this a good trade? Because it wouldn't be a good trade. And a couple of things coming to mind there is A, either the risk is too big, B, I'm not in a trade that I really want to be in, and I'm scared to get out because I don't want to take the loss. So all these things kind of bubble up. And so, you can dig into like Mark Douglas books, right? To where you need to let the system work. But also you need to understand what the system is, why the system is doing what it's doing. And again, going back to principles versus specifics, this is why taking any specifics from a certain trade system or anything, instead of taking the principles of it and then making it your own, that's why it never works out. It's never sustainable. If you read about any good trader, they have their own trading style because it matches their personality, matches their psychology, and it matches, they're building it so they know exactly the intricacies, the nuances of what's going on in it. So again, there's not going to be any hope of something. I'm not saying you don't want your trade to work out. Obviously, it's like, man, it'd be great, but it's not something where I'm extremely worried about it on a consistent basis. Because again, it's one data point within a vast amount of data points. But again, where are your expectations coming from? Are they based on just a finite data set that very well could be curve fitted? Or is it based in market principles that have lasted for 100, 150 years? So those questions there, I think would have been worth a lot of money to us 10 years ago. I probably wouldn't listen to the questions because I probably would have thought, as anybody that doesn't really understand something, probably would have thought, these aren't worth the paper they're written on. But I will say, if you do ask these questions, in a sense, it does give quite a bit more insight into kind of what you're doing. And so, again, just kind of wanted to come on and kind of share that really kind of revelations we had in 2019, but also the progress that we had moving forward. So for the last 6 months, we've been kind of running the Lotus as it is now. And it's just interesting when you kind of flow with the market, how a lot of these things, like hoping the market does something or kind of worry, it tends to disappear because, again, it matches our psychology. We're staying out of environments we know we shouldn't be in. And you just have a better sense of what's going on underneath the hood. So you're not being in trades for 30 days without knowing what's going on, or having risk on for that long without making money, and those sort of things that really can be frustrating as traders. And so again, we just wanted to kind of put those ideas out there, and hopefully they kind of help moving forward. But again, we love questions, comments, concerns. Reach out to us, Tom, if anyone has any questions. We'd love to have that. We love, again, anytime we talk to traders, we get more out of talking with them than they probably ever get to talking to us. So again, we love being part of this community and love what you guys do with the education.
Appreciate it. I remember there was one on the last slide you had. There's a question I always like to ask. If you look at a trade, if I didn't have this trade on, would I put the trade I have on now today?
Right. It really is. And one thing is, I think we got lost in our data sets a little bit, into where you lose the aspect of the actual trade you have on and the risk in that trade, what that trade is structured for, what the market's currently doing, because the data set says it's okay over the course of time. And so, because what you have is you have a finite data set of a market environment that may not be the case for the future, right? So any data set is going to be flawed. But again, what is it based in? Right? Is it based in, hey, I just saw this in the data set, it's okay, versus no, these are principles that last. And I know if I'm on the right side of these principles, then I should do okay. And so that's, I think, some of the issues we had, challenges we had that really, it's amazing too, because when we dug into this, like all the challenges we had over the course of the last decade kind of solved themselves. Like, oh man, I can't remember how many times that I've been sweating, you're in super high, you go from super low volatility to super high, and you're like, you get crushed in a position and you're frustrated. And then you start looking back and it's like, well, why was I even in that position? It was all risk on the downside. And if you look at a broken wing fly, or a fly in general, if you're generally delta neutral, if the market moves down and volatility expands, you're going to lose money. And so people, what you're betting on is the reversal, right? And let's just go back to the structure of the trade here. So when the market screams down, and let's say somebody rolls back, right? If they have a strategy where it rolls back, you scream down, which you're taking all of this Vega risk. So you're taking the largest number of your position is going against you, and you never know how much, because you never know how much the volatility is going to expand. It could turn into a 1987. It could not. You never know. So if this moves back, you roll it back. So let's say you're at your shorts when you roll it back. Well, then it reverses. Well, knowing your product, what you trade, let's say the S&P, does the S&P generally reverse very slowly? No, it doesn't. It usually bounces like a basketball, screams up. So now I've taken the entire amount of Vega risk, and now it's reversing and it's going outside my tent, away from my theta. And again, you in system, you're going to have, adjustments and things of that nature, but just looking at how I'm trading the trade, like, does that actually work with the market? Where am I making and actually losing the money? And what we found is when the market's moving down, we're not making money. So why are we at risk? Why do we have risk on? And so when we did that, you're like, I don't have a good reason why we would. And so when you take that out, we're like, wow, that cuts a tremendous amount of risk. And I talk about risk, talking about actual drawdowns that we've had, live trades, where it's like you literally are cutting that out of the data set. And so it makes a difference. And what's interesting as a trader is we have kind of had to be okay with sitting in cash. And cash is a fantastic position when the market is plummeting. It really is. So, and these are just ideas we had and looked at, our beliefs, our assumptions. Again, this is for us, but again, these questions I think are very important for any trader, trading really anything, not just options, but futures, equities, anything.
Absolutely. And trading in some ways is very similar to gambling as far as probabilities and risk and all that. So, we have to always keep that in mind with how much risk were we taking versus the reward, like you said. And I've seen several traders blow out just by taking too much risk. They do fine for a while, and then one or two big moves against them, and boom, they're gone.
Well, one thing that we always, Tyler mentions quite a bit is the absence of a data point in your data set does not mean that's the absence of the risk. And, we've seen this a lot of, like you mentioned, traders, you have a data set that says something. Well, that's, it's flawed already because it's not going to include every single piece of data that's happened in the history of the markets ever. So you don't really have that. And that's not even including what could happen. And so when you start looking at that of like, okay, well, what if scenarios? What if the market dropped 10% off of a 10 VIX, like gap down 10%? What would happen? And start thinking, because could it happen? Probabilistically, it hasn't happened before, but could it? And start asking these questions, because then you start really uncovering where a lot of your risk is. Options are very interesting because, options for income it's a big misnomer, because people think, well, you have it on all the time so that you're getting that fade all the time. Trading options is no different than trading anything else. Futures, equities, good trading principles are good trading principles. And, having bad risk reward trades is going to end up biting you in the ass at some point, and not mitigating risk or understanding risk. And the thing with options is when you have something that's four-dimensional, you've got time, you've got volatility, you've got direction, all these things interrelated with each other. It takes time to learn. It's four-dimensional instead of like a one-dimensional or two-dimensional stock or future. But there's a lot of edge in there. And one thing that I mentioned is one of the largest edges we have with understanding the price volatility relationship in the index, of just literally just knowing that when the market goes down, volatility expands and vice versa. That is a huge, huge edge. So if you're telling someone in Vegas, like you mentioned, gambling, Tom, if you tell someone that they have a 70% correlation that something's going to happen, that gives a massive edge into understanding, well, if I can cut out a massive part of my risk with a 70% average correlation, and it goes from 0.4 to 0.9. So it's always generally the correlations are going to be negative from volatility to price. That's huge for us. And the mean reversion of volatility. So that's a huge edge, because if you think about your data set, volatility being mean reverting, you can look back at 2008 all the way till now, and that gives you a volatility bracket of between, I don't know how low it got in 2017, maybe 8 or 9, all the way up to about 80. And if you look back in history, there's only been about 2 other data points in history where it's outside of that bracket. And so you can't really say that about a lot of things like price action, like price, because price is not mean reverting. So that gives us a huge edge of understanding how positions act in volatility environments. And because we really have 99% of all the data points in the history of the volatility, that's huge for us. And so those 2 things alone, again, understanding those core market principles is just a massive edge for us. And I hope a lot of people understand. If they don't, again, a lot of this stuff, if it's, you question it or refute it or any of that, let us know. The biggest thing we want people to do is poke holes in what we're saying, because that just makes us more robust and stronger. And again, if we didn't ask hard questions, we wouldn't have poked holes in kind of what we were doing and uncover some really some risks from what we're saying. So again,
So can
It's a
you
good
see the
idea right there.
chat? Jack had a question with the VIX at 14.9 and SPX at 33.75. What would you do now? Broken butterfly, all put flat fly. What kinds of trades are you guys putting on?
We're still, we still obviously work in the broken wing fly. And again, it's when we talk about the structures, and it's kind of hard to explain, but we want something that agrees with what we're trading. So the skew of the SPX, right? That's why, broken wing flies work in the SPX versus, let's say, you can do a futures product and it won't work at all because the skew is different. It's totally different. Like a flat fly may work in gold, but like obviously in the S&P might be totally different. So, when we're talking about, let's say where we are currently, we're going to still utilize that broken wing fly, right? And so what we're looking at is we're looking like, okay, what is the environment, right? So are we in a downtrend now, or is the market looking like it's going down? Well, obviously anybody that's followed the S&P right now, it's never going to go down, right? Ever. It's going to go up till the end of time. With that being said, is one things we look at is like, okay, when does this thing look like it's going to go down? Because if it's not looking like it go down, we want to have exposure on. Now that's going to be with a broken wing fly that gives us something where if the market continues up or goes sideways, that we're going to do well in. So another thing to think about, and Tom, stop me whenever we need to stop. I could go on forever, but so it's kind of like Wayne Gretzky, right? What's Wayne Gretzky's one of his most famous quotes, right? Go where the puck, skate where the puck is going, not where it is. And so, a lot of kind of when we're talking about neutral flies, right? I want something neutral that's delta neutral. Well, again, let's say if the market's going up or is a propensity to go up. Well, if I'm looking out here, the theta that I need is going to be where the market's going, which is out here, not where it is. And so if I need theta out here, well, this position here, obviously, you're not going to get a whole lot of theta out here. So maybe I need to break the wing a little bit more. Maybe not. I mean, and this is questions asked is like, where is the market going to go? Because if we think that the market's not going down, then that means that leads to the market's either going to go sideways or up. And if that's the case, we want to be able to profit where we think that market's going to go. Not saying we know where it's going to go. We want something, again, everything we do is very systematic and very mechanical. Again, with direction, what's very interesting and kind of boiling down, we want to get to theta by mitigating direction and volatility as much as we can. And so over the course of, we've checked back since the 1990s up until now. So we've got, very simplistic directional indicators that show us, okay, generally where is the majority of the direction going? And it's not based off what we think is going to happen. It's just based off of math, like a moving average, same principle. But over the course of that time, it's a flip of the coin. Sometimes it's right, sometimes it's wrong. And volatility wise, when, basically being once the trade is on, sometimes the volatility contracts, sometimes it stays stable, sometimes it goes up a little bit in our trades. And this is the course of for a long time. So again, volatility wise and directionally, it's not like we're always in contracting, we're in our positions, or it's not like we're always right on direction. It really is a flip of the coin. But what we're avoiding is we're avoiding massive volatility spikes. So when you do that, again, just look back in history of when you have volatility spikes, and they don't happen out of nowhere. Just look back and see. It's kind of interesting how the market works. Volatility begets volatility. And so kind of when we look back is what this allows us to do by mitigating those bad environments is get to that theta component. And so with everyone trading these strategies that kind of Aramir shows and everything, the edge it's the theta. When you start looking at the numbers, it's such a big edge. It's so nice to have that edge. And it's just, why is it so hard for us to move kind of to different trading strategies? Because having that theta edge is so nice. It's such a big cushion to where you can be wrong in direction and still make money. Volatility can still go up a little bit in your position and still make money. But again, one thing you do need to do is make sure that you actually are getting that theta edge. So if we go back to this, position to the right, you're seeing on your screen, I've got a 14-to-1 volatility risk to theta. Just look at it in dollar cents. This is a $50,000 position. I'm getting $90 in theta, 90. I'm taking $1,200 in volatility risk. Again, let's just ask the question, is this a good trade? if I'm trying to get to theta, is this a good trade? And it's just like, when you look at it in that sense, no. I mean, that's a whole lot of risk. And on top of that, I'm in a low volatility environment. So it's just like, so even if I'm right and the volatility doesn't go down, even if it contracts, I'm not, again, trying to get to theta, you're going to get $90 and you're at 59 days to expiration. So that's really not going to go up much for another probably 40 days. So again, this is what we're thinking. If we're trying to get to theta, are we actually getting there? Like, do we have a position set up to actually achieve the goal we're trying to get to? And again, we're trying to get to theta by mitigating our directional and volatile risk as much as we can. And so we do it, what we try to do is we try to avoid the bad environments where Vega is really a big problem. And again, with the directional risk, that's pretty easy. I mean, Tom, you probably agree, like, it's pretty easy to mitigate directional risk. Verticals, calls, whatever it may be. It's the volatility risk that poses a lot of the problems the challenges we had over the course of the last decade. But I would think a lot of people would say the similar things, that Vega is, a distinct risk.
Oh, definitely.
I don't know if that answered Jack's question. That I hope I did.
Are you different asset classes, like you mentioned, commodities, currencies, different types of things, or are you primarily like equity index options?
Yeah, so we've done a lot of work on like commodities, and what we've really kind of learned from this past year is we're doing a lot of research on them and testing on them, but kind of getting back to my points here. When you look at a price volatility relationship between, let's say, gold or oil or gold, or you mentioned currencies, Tom, we don't have the expertise in that yet. And I've been trading the S&P for like 15 years. And two, it's not something that I came across, like the price volatility relationship of that. Everyone knows it. If you ask anybody, like, when the market goes down, what's volatility do? They're going to tell you. But like with the futures, it's not that simple, right? You'll have sometimes, again, I think it's more true just to actual volatility, where when the moves get bigger, you have a bigger volatility in oil or gold, for instance. I mean, Tyler will tell you, we've been testing gold and trying to figure out the moves in that. It's just a totally different animal. Another thing to think about when we think about knowing our product, when you're talking about like S&P 500 versus, like, say, oil or gold, the S&P 500 is, you've got 500 of your bigger stocks, but also who's in the S&P 500, meaning who's investing in the S&P 500 or the SPX options. And the answer is mutual funds. You've got obviously huge institutions. And because they are doing that, most of them are mandated long, at least 90% long. And so when you think about this, if you think about the S&P, it's going to have that underlying push to be bullish, right? I mean, it just does. Now, when you talk about oil, oil can go anywhere and gold can go anywhere. And I think they are fantastic products to trade because there's a lot of premium in them. But for us, what we're trading currently, we kind of dive into more specificity when it comes to the equity indexes, just because of that edge that we really understand the price volatility relationship and just have, the comfort factor of having those edges in our favor.
And then Marcus had a question about, can you see the chat? Maybe it's easier if you read it.
Let me see. Where do I pull up the chat here?
There's like a toolbar normally near the top of your screen.
Oh, there it is. Okay. And it's Marcus.
Marcus, yeah. You're very welcome to join community. It's near the bottom.
Yeah, you're welcome to join community. How do you envision to do that? Okay, I'm trying to figure the question out. Quite different mindset of many trades here.
Do you have any forums or discussion groups going on, or is that something we could set up at Aramir? Or
we can definitely set it up. I mean, our on day to day. I mean, we're investment advisors. So we have clients, and this is what we do for them. I mean, and so, but, you know, absolutely anything we can do to help the community, Tom. I mean, we'd love to do that. And, you know, any more discussion or ideas and stuff is only going to make us stronger as well as other traders. So, absolutely.
Okay. Well, I'll see if I can set something up. Maybe we can have like a trading group or discussion or something once in a while, maybe every month or something. And you know, I'll kick some ideas around.
Yeah, just let me know. I mean, you guys are doing good stuff. So I love being a part of anything we can do to help. It'd be great.
All right. Well, I guess we're a little over an hour. Oh wait, there's one more question that's popped in. Has your strategy set changed from what you're using before, or simply changed parameters for the same set of strategies?
That's a great question, and I guess I wasn't too clear. So, pretty much what we did is we had we had a set of strategies where we had bullish, bearish, kind of a more tactical. We had 3 strategies. We had layers on them, and honestly, when we were looking at these strategies, and the reason it set up like that, because really kind of over the course of time, we had kind of holes that popped up, and we needed to plug those holes. So let's say, why did we need to offer a bullish strategy? Well, we kind of saw that we had a hole maybe in the bullish sense. So what we were trying to do is kind of cover these holes or plug these holes with another layer, right? Another layer of strategies. And so I kind of was telling Tyler this. He's like, don't mention that. And I was like, okay, I've got to. It's kind of like option view, right? To where they're just like, it's like whack-a-mole, where like a new problem posts up and they got a new update and a new update and a new update. And we kind of look at it as a big rubber band ball, right? To where it's like they add another rubber band and at some point it just all snaps. And so a lot of times you get technology like that, to where it's just you kind of add patches and patches and patches and patches and patches. And not saying that that's really exactly what we had, but in a sense, when we kind of went back and stripped everything down to the studs and rebuilt it, we wanted to take away all the fluff. We want to take away, okay, what's going on? Because what we really saw were 3 strategies with a ton of overlap to them. Like when you have 3 strategies, yes, one may be like leaning a little bit bearish, one may be leaning a little bit bullish. But if you look at, we mitigate the directional risk as much as possible. So really, you've really just got one big position that, why even have those separate? And that's kind of what we saw, was a bunch of overlap. And we were doing a whole lot of work for that. And so when you start really boiling things down to the actual necessities, what's driving the P&L, what's creating the losses, what we did is we rebuilt it. And yes, we utilized similar structures as in the brokering and fly. But now it is literally one strategy that we have on, and when it's the right environment and it's off, like I said, instead of having 8 different structures going on, moving all over the place, we have one. And instead of having it in a certain time frame, we move to where the market tells us to move in order to get our consistency within our relationship of our Greeks. And because that, like when I talked about execution time, it goes from 3 hours to like 15 minutes. And when you're talking, with us, that opens up a massive amount of capacity for us to help other individuals. And so I guess when your question is like, no, I would say that we're almost trading not completely different, because we're getting the same exposure. Our Greeks are still negative vega, still positive theta, and we're still managing the delta. But for the most part, to get to that exposure, we're going to be way, way more efficient doing it. And so again, like, we'll be in 2018, we're, out of the market for like 2 months because the market kept expanding, but we're still getting the same, if not better results with much less risk. And, you kind of look where you're out of the market. So you're kind of sitting on your hands a little bit, which is tough for traders. But again, I'd rather be in cash than in a negative vega position with a massive volatility spike. So, and then let's talk about this too, is, one thing that kind of eliminates a lot of times is we've had a lot of, Tom, you've heard a ton of different ways to, quote unquote, hedge your portfolio, right? Different hedges.
Sure.
And that's something when we looked at is with our positions, because we were having to hedge, we had almost 100% of the money at absolute risk. And yes, we'd mitigate the risk quite a bit, but we'd have to hedge that because there's no way we could withstand, let's say we have an 87 crash or a gap down of 20%, we couldn't withstand that loss. Well, now, when do those problems happen? Well, generally when those sort of environments are around, we're in cash. And even if we're not in cash, now that we can position size our strategies and get the same return with only half the account at risk, if not less. So it makes the hedging almost where it's not even an issue anymore. And two, a question, here's another question. Why do you need to hedge? Do you need to hedge because your trade's in a bad environment? That's a question. Okay, well, why is your trade on if it's a bad environment? So those sort of questions, these are the questions that, Tom, it was kind of like a 2 to 3 month process. If we start asking these questions, and anytime you ask the right questions, you start getting the mind going, and we started tackling a lot of our belief systems. And again, this is for what works for us. It might be totally different for anybody else, but again, we just wanted to share the principles that we kind of went through and the process and the questions to help people, ask those, because that's really what determines, sustainability is getting on the right side of that, but asking the right questions. So, so yes, our strategy has changed, I think, fundamentally, but we're still, again, we're positive theta traders. So from that sense, it's the same. Every other sense, we're almost completely different.
I know since you're in cash quite a bit, has that changed how long the trades are? How many DTE you start with?
Absolutely. So our DTEs will range all over the map, because we're going to go where the relationship is. And two, how do you get the right relationship? Like all kinds of stuff that surrounds a trade, that is a lot of work to figure out, okay, well, what relationship gives us what is comfortable for us, risk reward. But yes, I mean, we'll definitely start trades, and it depends on the volatility environment. Like you said here, like you kind of the example here, a very low volatility environment, it pushes you in, almost to 8 days to get that relationship. Now we won't go that close, because you do start getting, when you start getting really into expiration, you start kind of dealing with some different stuff, obviously gamma, but again, even positions that you can go in that far. But what you'll start seeing is actual decay when you go and you keep those relationships there. And Tom, I don't know how many times you've done it, but God, I mean, how many times where I'm sitting in a trade, I'm like not making anything for a month. And because you're not actually getting decay, or the volatility was just so much bigger than what your theta component was, that it didn't matter, like literally. And once you get to a certain volatility level, how low, it will not contract anymore. Even if the VIX goes down, your options won't contract, because market makers aren't going to be left holding the bag. And so, yes, we are all over the map when it comes to our DTE, which means absolutely the length of our trades, there's no set length to them. So, we'll put trades on, we'll let them do what they're going to do. And if we continue to be in the market, we'll put another trade on, continue. And as soon as what we look at tells us this is a bad environment, we're out. And we're going to wait until it tells us to get back in. And so again, do you miss out on overall return? You may. But what you cut out is a massive amount of risk. And so again, our risk reward went from 3 to 1 to 7 to 1. And that's not because we improved return, it's because we cut risk. So we had the same, almost a little bit better return with our new strategy, but it's all risk that we cut out. So yeah, it's definitely going to vary than what we had, Tom, for sure.
I know, so that's one difference in mindset between, say, directional traders and option traders. Is directional traders, they'll cap the risk on any one trade to maybe 2 to 5% of the total account, but the option traders tend not to do that. You'll put much more of your account at risk. But obviously, like an iron condor, for example, you'll have 9 or 10 wins in a row, and then 1 or 2 losses will wipe out all the gains.
Yeah, one thing we always say, we say this to our clients, say this to everybody: it's not just your destination; it's how you get there.
Right.
And for us, I'm glad you mentioned condo traders, or naked straddles, or whatever you may be. I mean, people talk about picking up dimes in front of a steamroller, and not saying I know some really good iron condo traders that do very, very well, but it is one of those. It's like, well, you just know that that's going to happen. And for us, and again, why do we love the butterfly so much? Because you can create a very nice journey. And so with us, we look at daily fluctuations of our positions, and we don't want massive fluctuations. And you mentioned kind of what you size per trade. And so very interesting, we have more trades per year now. But what we've done is per trade, we've taken our risk down to that level, to where we're not going to be risking on any one trade really more than 1 or 2%. And what it allows us to do, it allows us less risk when it comes from a trade perspective, but also it allows us, because we have more, it allows us to get to our we're pretty much getting to our statistical number more. I mean, again, to get to flip a coin 10 times, in order to get that 50-50, you want to flip it at least 50. And so what we want to do, not saying we have 50 plus trades, but we just want to make sure and get to our expectancy every year. And so that allows us to do that a little bit more efficiently as well. So again, to us, it's just one of those where when we kind of know we're on the right side of some core principles, things start to fall into place a little bit easier. But again, this kind of worked for us. Again, ask the right questions and it'll kind of send you in the right direction.
Very good. Okay, so Tyler says if there's any questions that haven't been answered, or you just want to say hi, just email you guys at info@blackpiercapital.com.
Yeah, we'll answer it. We, again, love discussions. Let us know. Again, love what you guys are doing, but anything we can do to help, this has really helped us, especially over the last decade looking back. And another thing too is look back at your results. See, really try to figure out where your gains and losses are coming from. And, if you're happy with it, that's fantastic. But I think that's very important things. If you want to trade, sustainably and, trade for a living or trade for, a long time, just like anything, just put the work in and see what goes on.
And another point to that is track your trades. Have some kind of trade diary or journal where here's a trade I did, here's the reasons I got in, here's what I did during the trade, here's the results, and track all that. And even tag it to different kinds of trades. You can track performance of different types of positions that you do. Analyze what you do and see what's working and what's not working.
Absolutely. And one thing, especially with complex options traders, is try to break down your gains and losses per your Greek. So how much did Vega attribute to it, theta, and delta? Those three things. Because when you start doing that, you start to really figure out what's driving your trades and in what environments were you in when certain things were driving our trades. When we started breaking that apart and really seeing that, it really started to enlighten us. I'm like, literally, there was a time, I think I was talking to either Wayne or Tyler, and I'm like, oh my God, we're in just one giant Vega position. Because you start seeing like, oh my Lord, it's 15-1 right now, this Vega versus what we're being paid. If the market expands at all, we're getting throttled. So it's just like, what are we doing? And those sort of aha moments, you're like, So, but that's what leads you to breakthroughs. That's what leads you, and unfortunately, not fortunately or unfortunately, but it's the way life works, right? Your challenges make you stronger. That's the weights that life gives you. So fortunately for us, and we've been, trading for a long time, that pain and those challenges hopefully have created us to be better traders, more consistent traders for our clients and for us, but also to help out others, and that's, there's some things that were said to me 10 years ago that I'm just now getting now. Like, I just remember and like, oh, that was extremely deep. That was kind of Yoda-esque, but I didn't understand it 10 years ago. So sometimes it takes time to kind of come around, but again, hopefully our challenges, help out other people.
All right. Well, I see Jason's got one question, but I think that's going to take a little bit longer. So maybe Jason, you can to write to the team there at Blackpier, and then maybe they can continue that about the cluster theory.
Just, shoot it to our email, and we can answer it for sure.
All right. Well, hey, thanks a lot, guys. Great discussion. Really appreciate you guys coming on, and I'm sure we'll have you back. Like Itzhak Perlman, the famous violinist, said, anybody can invite you to perform, but it's when they ask you back a second time that you actually did something good. So
that's right.
That's we'll have you back, definitely.
Great. Well, appreciate it, Tom. Appreciate everybody listening up. I know everyone's busy, so we appreciate the time.
Yep. Thanks, everyone. We'll see you next time.